I'm going to show you one very simple strategy, step by step, that's going to allow you to make consistent profits every day, week, month, and year. So the first thing you want to do is just pull up an underlying that is trading around its lows for the last year. So as you can see, NVO last traded at $77.15. This is, showing the past year or so, and as we can see, this stock has been beaten up pretty bad, and we are pretty much sitting at the lows. Okay, so the first step is you want to find an underlying that is trading at the lows of the last trading year, basically. The second thing you want to do is make sure that the IV rank for that particular underlying is over 30. Okay, and then what you also want to do is you want to make sure that there are no earnings events over the next 45 days or so for this particular underlying. And once you've ticked off all of those things, you can move on to the next step, which is selecting an expiration date, an options expiration date that we're going to use to place a trade. So as you can see here, the earnings event thing just needed to update there. It is a Saturday, so the market is closed, so we're just going to mock up an example position, and now we are presented with the option expiration dates here. We want to pick an expiration date that's between 30 and 60 days out in time. We also want it to be a monthly expiration date, not a weekly or quarterly. So there's only one that fits our criteria right now, and that is April 17th, 33 days out in time. So we're going to open that up, and now we can see the options chain. We have calls on the left, puts on the right, and very simply, we are going to sell one put. Okay, so we're going to make the assumption, if we go back onto the chart, we're going to make the assumption that because price has been beaten up so much and that we are at the 52-week lows, we are going to make the assumption that price will mean revert a little bit and move higher. However, if price doesn't move higher, we're still going to make money. If price does move higher, we'll make money. If price moves sideways, we'll make money. If price even moves lower, we will still make money, as long as it doesn't move too low. Okay, so let's just go back over to the options chain, and what we're going to do is we're going to sell a put. So when you buy a put, you want price to go in that direction. You want price to go down. When you're selling a put, you're taking the other side of the trade and you're doing the opposite. You want price to stay away from that contract. Okay, so we're going to make the assumption that price isn't going to move too much lower. Now you want to sell a put that's around 20 to 30 deltas. So on our delta column here, we have a 22 delta and a 39 delta. So in this instance, it's a little bit tricky because there isn't really anything around the 30 delta. So we're going to have to be either a little bit extra conservative or a little bit extra aggressive. So this is a matter of personal preference, but we'll show you what they look like. So let's just be a little bit conservative and go with the 22 delta at this 70 strike. So we'll sell that, and we are going to collect $1.43 per share. So that means we're going to collect $143 in total on this trade. Okay. Now our broker is going to require $800 or just over $800 to open this position, and we're going to collect 143. Now the chance of actually making money, as you can see at the bottom here, is 88%. So we have a pop, which is probability of profit, and that is your probability of making at least 1 penny on this trade, and that's currently 88%. And if we were to get out at 50% of max profit, we have a P50 of 93%. So we have got an extremely high probability of success on this trade, and this is where we are going to get our consistency from, by just stacking consistent winners back to back to back. Now you might be thinking $800, that might be a bit too much for you. You might not want to allocate that to your portfolio or to this position or whatever it might be. What you can do is simply use some of this premium to buy another contract a little bit further out, and that's going to limit your loss. As you can see now, our max loss has been significantly reduced, and so has our buying power. Our profit or our premium that we collect has been reduced as well, but our return on capital now is a little bit higher. or in a really and truly, it's kind of about the same. There's not really too much difference, but that's just because of this just particular underlying. Generally speaking, you will have a higher return on capital. So let's just see what it would look like if we were to be more aggressive. So if we were to be more aggressive and go with the 39 delta instead of the 32, we would collect $315 up front. Our broker is going to require 2.2k in buying power to open this position. So as you can see, a lot more buying power is going to be required. And our pop is slightly lower, so it's 80%, and our P50 is 87%. Now, if we were to buy another contract here, you can see the power of a spread. This is called a spread. And now our buying power requirement has dropped to $331 as opposed to $2,000, and we are still going to collect $169 up front. So we're going to get a very nice return on capital, very high probabilities of success. And this is what it looks like. You just need to kind of play with the position a little bit and see where the numbers look best. And you pretty much want to do this over and over again as many times as possible, have as many occurrences as possible, and essentially let the odds work out in your favor over time. And in order to survive in this business, you need to make sure that you are sizing your positions correctly to mitigate any sort of short-term variance from being able to wipe you out. And so in order to do that, we have created a free position sizing template. The link for this will be in the description. And it looks like this. So the way it works, you enter in the size of your portfolio. So say if you have a $15,000 account, you enter that. And then you will then enter in the current VIX level, say if it is 12.7. And then everything is going to be automatically calculated for you. All you need to do is use this information to form the backbone of your portfolio. And over the long run, you will be absolutely fine. If you would like to learn in more detail about what we do and how we do it, again, the link for that will be in the description. But click on EDS Premium this time. Get yourself signed up. Inside, you will have access to this example portfolio that we showcased in this video, and you'll be able to see all of the positions that we place, all of the adjustments that we make. You'll be able to see absolutely everything from start to finish. There's a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish, and it's a private community. So if you're ever stuck, you can speak with myself directly or with other like-minded individuals, and there's a 100% money-back guarantee. So once you've been through the course, follow some of our trades, after 6 months, if you're not profitable, we'll just work with you for free until you are, or you can simply request a full refund. So it is completely risk-free. It's $9.99 a month to join. The price will be increasing, but once you're in, the price is locked in forever at that level. So you don't need to worry about price increases. So you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. You can rely on us, but we don't want to keep you dependent on us. We want to give you the skill. And once you've learned it, no one can take it from you. And we aim to get you to a point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.